W11 Company 4 is a manufacturer of customer goods based in America and also operates in Latin America, country of Sereno. Our mission statement. Mission statement is to be the lead producer of consumer goods with the lowest affordable prices. In the past 2 years, Graf's company performed not well to the other companies. We started drastically decreasing to our competitors in overall ROA, ROE, market share, and total net income in the past 2 years. As executives, we conducted a strategic operation to open a new plant in year 3 to maximize our profits. Our goals for production expansion were in Sereno due to low labor costs and favorable exchange rates. To finance our investments, our company acquired a vast amount of bank loans and bonds. Unfortunately, our plan to open a new plant in a foreign country did not pay due to substantial overall expenses that our company incurred. Okay, our strategy, Graf's overall strategy, would practically not be the same. There was a mutual agreement that the strategic plan throughout this game was pretty well thought out approach, but we took a large venture. We had a high risk, high reward state of mind. The firm came in last place due to our investment overseas country.
Crafts was incorporated to serve as a leading manufacturer of consumer durable goods in Latin America and sales offices located in Morocco and Sereno. In addition to those locations, we have manufactured plants in South and Central America to allow to ease of distribution to our market. Crafts offers modern qualities products at lower cost with constant improvement in areas of product research and development. This will enable us to compete with other market leaders by price pointing our product at the same level as lower qualities product offered by those competitors in manufacturing, delivering, and marketing. We strive to provide goods to consumers in a ways that will create superior brand value. We can achieve our desired results by capturing marketing insight, shaping our product offerings, and developing value beyond our firm has intervened in core markets by conducting various market analysis with fundamental understanding of consumers' buying behavior for its marketing of durable product by achieving the targeted qualities of its production. We have been able to reach our central goal of producing quality good at lower cost. With that, our financial support of investors and shareholders, our enterprise will increase to exit. Our consumer studies ensures that we force on products that are most modern and in demand, which helps inspire additional confidence and security within our financial makers who are attractive to our credit rating score and balanced budget. We also invest in our sales team by providing continuous training and development. Competitive, generous salary and rewards and bonuses to motivate increased productive sales. Our firm will keep on satisfying our shareholders by running an effective and profitable firm.
Hi, my name is Philip Klesko. I'm a Chief Marketing Officer. Today we're going to be looking about functional strategies for the year 5 and 6, plan versus actual numbers in a 2-year overcast report. This report will carefully examine the areas for marketing operations, production, and finances. We'll go into the decision-making process and how to influence the results. In this this slide, we can see in marketing operations, number of salespeople we dropped in year 6 due to we're trying to cut the costs, so we can fire a lot of people over there. We couldn't sustain all the costs that we incurred. Sales for year 5, whereas originally we hadn't planned. For year 6, we had minor changes because of our financial situation. We spent more on our advertisements, you can see down on the bottom, but that not really helped us a lot in our year 6. We have actual versus plan numbers for operational production management. We decided to open a new plant in Sereno, which was a risky move. It had showed us with the numbers and the production. We could not sustain both plants because we were not making money to cover the cost. So in year 5, quarter 4, we decided to shut down the factory in America. Try to recover from losing sales. In year 6, quarter 3, we only used 4 lines and we're still overproducing. As you can see in this table, our inventory was 610. So on the bottom right here, 610 beginning, so that's 600 to 100,000 of units, so we had a lot of costs trying to store those. One reason for our production was not solely helpful because we stocked out in year 5, quarter 1, up on the top. So we lost a lot of customers that never got back, so that's what we were struggling. Since the beginning of the game, we decided to spend significant money on research and development for the new features for our product. And we want to provide our customers with the newest production on the market. However, due to the net loss for every quarter for the past 2 years, we had to cut costs for our research and development section, and we did not achieve the goal to produce Model 4 products for our customers. Since we closed the factory in America, we had cut the costs on training expense because we did not need to hire any more workers. So as you can see right here, our plan was 320, actually was 360, we're doing pretty good. And here, year 6 planning was 320, we only had 110. And it was really bad. We could not achieve Model 4 that we originally wanted. And for our training expenses, it just went significantly down because we hired a lot of people. We did not need to hire any more workers. Here you can see our market share. Our plan was 26.3 for year 6, and we were only at 11.5. So we dropped more than 50% of our original plan. Well, it wasn't really good. We lost a lot of our customers to our competition in year 6. Here we can see active production. So from the year 5 quarter 1 to year 6 quarter 4, it shows how many lines were open, how many hours. In year 5 quarter 4, we shut the factory in America, so we're only producing in Sereno. And because we're overproducing, right here in year 6 quarter 3, we only had 6 lines open, and then here we only have 4, trying to produce less because we were overproduced. Okay, here we have planned unit material costs of production. So this is planned, this is actual. As you can see right here, we saved about 20 cents overall from our planning. That one, because we went to quality 3. We then never got to quality 4 like we originally wanted to do, but we were saving about 20 cents from 188 to 164 overall.
Hi, my name is Gloria Acevedo, and I'm the Chief Information Officer. Today we're going to be looking at our performance targets and our actual results. We're going to start first with net income. In years 5 and 6, we decided to focus on a low-cost strategy, keeping our prices down while improving the features of the products. We predicted this would give us a competitive strategy over the competition and boost sales. The strategy did not succeed, and both years were in the red. Next, we're going to look at unit production cost. Graphs aimed at keeping the unit price down by employing cost-saving measures and including adopted just-in-time inventory practices. This is an area where we were able to remain successful. The new practices paid off. Next, we're going to look at our stock price. Our goal here was to continue producing innovative products that would appeal to investors. Graphs was able to produce a competitive product and sell it at a low price. However, the cost of maintaining our domestic plant open while carrying so much debt again placed our company in the red. Market share. Our new ad campaign did not generate enough sales to stay competitive in the industry. Increasingly low sales figures made it difficult to obtain the market share we had hoped to have achieved. Compared to the market, we ranked in 3rd place in year 5 and 4th place in year 6. Next, we're going to look at our ROA. Our strategy to keep prices low while investing in Sereno by means of acquiring loans did not pay off. While the plant in Sereno managed to do well, our domestic plant lost revenue, which left our company standing in the red. And last, we're going to look at ROE. Dollars allocated to R&D to create competitive products, the risk of opening a new plant in Sereno, while with loans and low sales in our domestic market, all contributed to taking our target numbers down by over 15%.
I'm going to be talking about the variances for year 6 income statement that were greater than 25%. Total sales was negative 44%. The reason why is a decrease per quarter in M1, M2, and in M3. The second one was less value-added taxes, negative 62.18%. The reason why was substantial bank loans and bonds outstanding. Our gross profit was negative 56.68%. I projected a higher profit margin in the performance statements. Advertising expense was negative 32.8%. Projected a higher advertising expense as well. Sales commission 63.50%. Increased more than expected by 60%. Transportation expense was a negative 52.86%. It was due because we opened up the new plant in Sereno. R&D, negative 83%, invested a large amount in year 4. Training expense was negative 52% because we're training a lot of people in Sereno. Storage expense, 183.41% because we increased production in years 5 and 6. Next, I'm going to talk about the balance sheet for year 6. The variances that were greater than 25% are as follows. Time certificates of deposits was 50%. We purchased more than expected. Inventory was negative 54% because we boosted up inventory from years 5 and 6 because we're extremely low for the prior years. Net manufacturing equipment was negative 60% due to the new plant in Sereno. Total fixed assets was 101%. The new plant was an abundance of assets. Accounts payable, 100%. Major debt, bank loans was 100%. Incurred a lot in year 4, year 5, and 6. Current liabilities was a negative 90%, vast amount of liability as projected. Bonds astounding, 100%. Plan to purchase no more following years 5 and 6. Capital stock, 100%. We're not going to repurchase anymore. Accounts earning was 100%, decrease to negative net profit margin. Lastly, I'm going to talk about the variances and the statement of cash flows.
Hi, my name is Nancy O. I'm the CEO of Grafs Corporation. Today I will be going over the company's performance of W11. As you can see here on this column, our company is Company 4 Grafs Corporation. Our ROA for end of year 5 was 3.04%. Our net income was below what we expected, therefore our ROA was in a negative, in which in turn our ROA was below industry average. ROE, we were also below industry average because we were, more money was leaving our company rather than entering. With the market share, our market share is above industry average due to the fact that we maintain our customer base, and our previous year 3 and year 4, we had a good standing in terms of net income. Our stock price, however, was below industry average. We were at 77 cents per share. Unit production costs, we were a little bit above industry average due to the fact that we had a production plant in America, in which that's why our cost production was high. Our total net income for year 5, because we're our expansion to Sereno, we exhaust all our cash flow. Therefore, income coming in, we have to repay for bank loans and interest on the loans. Therefore, we incur a net loss for end of year 5. For end of year 6, we were, for ROA, we were negative 49.8%. We were way below industry average due to the fact that we had opened the production plant in Sereno, and our cost, operating expense was above what we had expected. ROE, we were extremely below industry average. We decided to close down our plant in America. Therefore, we depleted all of our equity, and our return on equity was negative 304%. Market share, because of all of this overexpend, we had lost our market share. Therefore, our market share was way below industry average. Stock price. Our stock price, due to all of this problem, losing customer and high cost on operating expense, our stock price was had gone lower to 13 cents per share, way below industry average. Unit production cost, because we closed America, production plant in America, we maintained the production in Sereno. Therefore, our unit production cost was way lower than industry average at $2.54. At end of year 6, our total net income was at negative 4,203, and this is way below industry average, where we were not meeting our sales goal due to the fact that we took a risk opening up production in Sereno.
Here's my future plan. The future plan is that we need to have a plan to reduce our cost. Moving our production plant to Sereno is a solution because the cost of production in Sereno is cheaper. It could be the way to cut down our costs. Also, we need to invest more on R&D to release new model. We fall behind other competitors too far in new model. It is a disadvantage to compete with other competitors having the same models as other competitors. We should avoid unnecessary loan. The low interest costs us a lot of money, and it makes us lose money in year 6. Once we will have positive net income, we will make, if we make any profit of it, we will spend 20% of the into R&D, 5% on advertising, and 5% on training, 2% on increasing the salary and commission for the salespeople. The remaining will spend on new lines